Thank you, Carol. Now it is my pleasure to introduce our first panel this afternoon, Disrupting Investment Analysis Through Data and Data Science. Our panel moderator is Peter Wendt, who earned a PhD and is a CFA charter holder. Peter has experience leading complex multi-year international financial projects and has authored 5 books on risk management. Currently, he lectures at Columbia University and explores the boundaries of machine learning. Peter, take it away.
Thank you, Chris. Good afternoon. Our panel addresses the disruption of the investment analysis process, and we are looking essentially at how data science, and alternative data can improve and in a way disrupt the process that we are all familiar with. I have 3 experts at our disposal, and they are very keen on sharing their views. So let me ask Katya, Stephen, and Sandeep to briefly introduce themselves and speak about how they create magic through numbers and computers.
Thank you. My name is Katya Chuprina, and I'm Chief Strategy Officer at ThinkNum. We are an alternative data tech company. And what we're basically trying to do is index all the economic activity that's been moving online. So over the last 10, 15, 20 years, you've probably seen companies moving, their products online, so they're selling online, they're hiring people online, they're also firing people online, and those people tend to leave employer reviews. So all we've been trying to do is really just capture all this data on a daily basis and structure it in a way that's actually investable. The problem with a lot of web data is that there is a ton of it and it's really hard to process, and the reason for that is because it's extremely unstructured. So we take the very fleeing web data and we structure it in a way that actually becomes investable. My personal background, I was an investor both on quantitative and fundamental side. Quantitative still being kind of the stronger part. But during my years as a quant, I realized that there is a ton of data out there, and a lot of this data can be extremely useful, but to get it to the useful part is nearly impossible, even with the smartest people in the room. So I kind of made it my career now, I guess, to make data that's otherwise very interesting but not investable, produce some sort of alpha, some sort of signals, and I joined 2 of my classmates actually in this effort, and it's been really great. It's a fun space to be in.
And I'm sure we're going to ask tons of interesting questions. All right. Sandeep.
My name is Sandeep Varma. I am the founder and CEO of Equity Data Science. What Equity Data Science is essentially a quantitative overlay for fundamental investors. About 6 years ago, I was a quantitative analyst on Wall Street. The chief investment officer at Morgan Stanley was a guy called Steve Galbraith. He was also the number 2 guy at Maverick Capital, a $15 billion long-shot equity fund. He had helped create something called MavRank, which was essentially applying quantitative strategies, but for a fundamental investing process. He hired me when he started his firm, and he basically gave me a template. He said, look, I want you to build a quantitative framework, but taking into account the mindset of how a fundamental manager looks at investments. So we basically started combining alternative data with market data and internal data, and essentially created this framework, which over the last 2 years we've commercialized. So we help investors along 3 lines primarily. One is idea generation, the second is portfolio construction, and the third is risk management.
Stephen?
Hi, I'm Stephen, co-founder of QuantaMental. QuantaMental is an investor portal geared towards retail investors where we're trying to democratize AI and quantitative investing. Our goal is to help the average retail investor make sense of stocks, ETFs, options, and cryptos.
Cool. Thank you very much for those introductions. And Stephen, let me turn to you with my first question. So we hear a lot about artificial intelligence, machine learning, data science, structured learning, trees. How does this come together in the processes that you look at? How does this help the investment management process?
Sure, Peter. I'm not going to plug what we're doing, obviously, but let me talk a little bit about why I think AI is going to be very disruptive. My background was first as a fundamental analyst that became a quantitative analyst. As far as I'm concerned, AI makes it much easier to find both linear and nonlinear relationships. That's the challenges facing the average investor, average analyst, average portfolio manager. In my opinion, AI investing leads to more probabilistic outcomes. What does that mean in just in English? It means that you're taking a little bit more of the uncertainty out of investing, which is more or less what's going on. AI, as far as portfolio management goes and portfolio construction, I think it leads to more robust allocations. We can talk about that in the Q&A, what we're experimenting with. But if you look at the typical Markowitz CLA algorithm, and then you compare it to something like hierarchical risk parity, it's without a doubt that hierarchical risk parity that uses clustering, that's just trees, leads to more robust allocations.
So it's interesting. So basically, you are applying probabilistic statistical methodology on data. Some of that is structured, some of that is unstructured data.
Yeah, and I think one point I missed out of all that in my analysis earlier is that it permits you to look at larger data sets. So before, when I was looking at a consumer company in Brazil, because that's what I did, I could only handle a certain amount of data set because it was in my mind and it was in Excel. Now I can use deep learning analytics. I can dump in a lot of things into the algorithm to try to make sense of what's driving consumer stocks in Brazil.
It's interesting because it kind of brings parts of the fundamental analysis into it, a lot of quantitative analysis. It's a combination of that. So it's almost like a QuantaMental analysis. And part of this QuantaMental analysis is to combine alternative data with financial data. And from your perspective, Katja, who looks at this from a completely strategic perspective, where do you see the coexistence of this evolution of fundamental investment and quantitative investment, this QuantaMental investment go?
Sure. So first of all, I guess I have to disclose that I'm a complete skeptic on AI right now. I think if there was true AI out there, we would not be sitting here, none of us. It would be making decisions for us, hopefully. But in terms of QuantaMental, so I think the right question is really not can the two coexist, but why did QuantaMental emerge? And it really emerged in the last, 5 to 10 years. Mm-hmm. And the way I think about it is, you think about the fundamental investor 10, 20, 30 years ago, and the process was pretty standard, right? You look at fundamental data, you look at earnings, sometimes you look at technical data, how the stock is performing. But back in the day, 70% of kind of fundamental data explained the stock movements, right? How the company was actually performing. Today, this number is actually below 15%. So you start kind of wondering like what has changed about the process itself and why fundamental data is not really predictive of stocks anymore. And I think this is one of the reasons, it's purely my hypothesis, but this is one of the reasons why QuantaMental emerged, is because as more data started coming into play, and this data, web generated obviously is one and the one that I know the best, but there are a ton of other web sources, tons of other data sources that really affect the investment process. So once that big data started coming in, a lot of investors suddenly were kind of at a loss because they might have done the fundamental part right, but they didn't necessarily translate into investment results. And I think the recent underperformance of all the active strategies is a really good example of this. But we basically went from a world where fundamental analysts could be at the center of it and just make decisions and be right most of the time, to the point where now they really need tools around them. So I see QuantaMental not as there's a continuum between like quants and fundamentals. So I see QuantaMental as somewhere like along the continuum. It's really a stretch, right? Like you can be more or less QuantaMental, but the human is still the center of that decision-making process.
So ultimately, what I'm hearing is that there is quantitative data, there is quantitative analysis, there is financial data, there is financial analysis, and there's also this abundance, or I would say overabundance of data. And then the question is, how can an analyst structure it in a way that this data can provide meaningful information to them?
I mean, that's exactly where the tools come in, and I think that's exactly where QuantaMental comes in. Because QuantaMental, it's fundamental research process, it's fundamental investment process. It's still the same. It's not a strategy in itself. It's just a way of processing all this big data that's coming. Whether you like it or not, it's coming, and you have to deal with it. So we're all kind of in the same boat. We cannot really decide, okay, I just want to be fundamental, nothing else. So QuantaMental is purely a way of using tools that are being built right now by a lot of tech companies and sometimes even banks and buy side and sell side. But it's really a way to use those tools to leverage the opportunity that the human brings in, like the skills that humans bring
So
in.
do you think there is better alternative data versus not so good alternative data? I mean, if you look at the spectrum of possible alternative data, is there a type of alternative data that you say, hey, this is the gold mine? Perhaps you can't say that. And hey, we shouldn't be using this.
I mean, I can give anybody in this room, 10 different data sets that have been proven to have generated alpha, and every single person will probably find alpha in some of them and not others, and it's always going to be different. So again, it's all about tools and how individuals use them. Humans are very good in connecting, and I'm always team human, by the way, but humans are very good in connecting, intuitive thinking, kind of more strategic perspective, more contextualizing what's happening in the market. So to say that a specific data set is good or not, it might not be clean. That's a much bigger problem. But in terms of finding alpha in something, I think it's up to the investor, and there are a lot of really, really talented people out there who found things that you would just never expect to even look for.
So let me just keep on this topic, and let me ask Sandeep about what his view is on integrating alternative data. I mean, you guys work on equity. You guys are trying to create more alternative ways to analyze equity. How do you integrate alternative data into your investment process?
Right. I think to answer that, you've got to first understand why you use alternative data, right? So there are two primary reasons why you use alternative data. One is as a validation process. So your fundamental analyst or PM comes to you, says, hey, look, Chipotle, I think there's a turnaround story here. And, find me some data point which says, okay, that Chipotle is going to be okay this quarter. So you go ahead and you look at all the different credit card providers out there and say, okay, look, I think Chipotle data is looking good for this quarter. So that's the validation aspect. The second is for idea generation, which is you could look at all the restaurant data across all of the credit card or even one particular vendor out there and say, look, across the restaurant space, I think the data is going to be good this quarter. And you know what, I want to reflect that good sentiment that's coming across for restaurants with exposure to a few stocks. And the way to do that is essentially you take your philosophy, which is a turnaround story, where you say, okay, this is going to be turning around. How do you quantify that? Maybe it's the margin trajectory. That's a way you quantify that. You take in the alternative data, you normalize it such that you can either look at quintiles or you can look at z-scores, and then combine that into a systematic process to say, okay, across the consumer names or across restaurants, the combination of increasing margins and then just the credit card data across the restaurant space saying they're going to beat same-store sales by 3%, that is going to give me a good result or a good set of companies that I can do further deep fundamental work on. Does that make sense?
That makes sense, because it's I think what you're speaking about is really that what you're using is numbers. Is you're looking at credit card receipts, which is hard numbers. You're either going to go there or you're not going to go there. Either you're going to spend $10 or $15. But there is also another aspect of alternative data, and that is to take non-structured data and add it into the process. How do you? What are your views about, let's say, like NLP, natural language processing? What is your view about that, introducing that into the mix?
Right. So I think ultimately everything, if you've got to sort of look at it in a structured way, you have to convert that unstructured data into structured format. So traditionally, people are still using a lot of the firms that we work with. They're still using traditional relational databases, but I think over time, maybe you could have technologies such as Hadoop, Spark, those could take over and help take that unstructured data, but ultimately you have to convert it into structured format so that you can compare it and mix all the different factors together.
So you think we are not there where we can just grab any type of alternative data and just dump it into an analytical program, or is it something that we need to wait for another couple of years?
It's difficult. I mean, there are some technologies, there are firms for example, us as well. If you send us data in some particular format, then we can easily take that and ingest that in. But I think across all these different alternative data sets, because they're so disparate, it's difficult to sort of find a common ground and say, hey, let's just plug this in. If everything is stickerized, and if you can say if everything is stickerized and I have the data per quarter, then you could say, okay, let's just run an algo and then compare it with the consensus data historically and then come up with a prediction. That's possible, but then getting that dirty data and then structuring it, that's probably not standard across all the different data sets.
I mean, anybody who has worked with data knows that cleaning data is
just
the
a
absolutely
mammoth task.
best part of the process. The rest is
Everyone loves it, yes.
Yeah. I mean, it's data cleaning is very, very entertaining. But it also, there's a reason we do this, and one of the reasons is that we want to get better data. We want to get data that perhaps nobody else has access to, or we have an insight into that data that can give us an edge. And the question is, how can we generate alpha from that? Stephen, what is
so
your
we're
view
a little
about
bit different. So we're taking the data that either your company or Katya's company is creating, and then we're actually trying to standardize it, normalize it like Sandeep was talking about, and create multi-factor strategies and come out with an output. And then we apply QuantaMental approaches to say, here's some stocks out of the top buys. I think the biggest challenge is, you're asking about how do you make sense of it, is what do you put in? So I think I have a similar bias to Katya. I don't think you should just put a data dump. And I've got into arguments with people here about that, the idea of just data dumping into a neural network and just figuring out what the output is and just hoping it works. We tend to take a more qualitative bias approach. So the CFA should at least approve of me there, where we talk about, well, how do you want to bucket things? How do factors interact? Does it actually make sense? Is it causation versus correlation? That's a cliche, but more or less along those lines. I do think you can get a lot of insight from alternative data. I do think you can get a lot of insight from natural language processing. It's about how do you make sense of the data? How do you clean it up? Can I talk a little bit about cryptos? Because, Peter, you and I were talking about that. And I think this is going to go right into what you're talking about, alt data. Crypto is a completely opaque asset class. Nobody really knows what drives it. I'm not going to sit here and tell you that, even though we've got a pretty good Bitcoin algorithm. But I can tell you that natural language processing has a place in it. Sentiment data has a place in it. But what is its place? What should you be putting in there? How should you think about it? How should you think about decay rates in terms of the data you put in? These are all the challenges that people face when they bring into alternative data. But I would posit that they do play a role. And I'm a total skeptic of using social media data for stocks, and I'm probably wrong about that, but natural language processing, I would argue, as a form of alternative certainly plays a role.
Because it's interesting. I think there's a kind of a differentiation between, if you talk about technically about natural language processing, that there are Twitter feeds or Instagram feeds or whatnot, which are extremely poorly thought out, but they are very voluminous. And you compare that with, let's say, 10K discussions. Because that's structured. I mean, the 10K discussions, even though it's language, it's pretty structured language. It's legal, and compliance has vetted it. You know what you can say and what you can't say. So in a way, there's a linguistic structure on the data. Isn't that kind of a better way to extract insights?
I would probably respectfully, strongly disagree with you. I think you could probably get greater insights from Twitter than you would from the 10K. And if I can give you one example, one of my high school friends ran a hedge fund. I'm not going to plug his hedge fund here, that was able to figure out Brexit was going to happen. And he got up on CNBC the next day and said, we look at Twitter data, and the Twitter data was telling us what the vote was going to be. And here I am, I'm trained a poly-econ. I said, there's no way this is going to happen. I've got a family from India. My uncle's a former ambassador to UK from India. I thought I knew what I was talking about. You're out of your mind. And this guy used Twitter data. I think there's more insight in data than that. It's just how do you combine it.
How do you empirically test some of that?
I can tell you what we've done with cryptos. We use options, but I can tell you what we do with crypto. So this is my own bias, as opposed to saying pick Reddit, Twitter, or Instagram. There are a couple of other social media sites. Take everything together. Use a law of large numbers. If the mass and the mob is saying something, if the sentiment is going in some direction, there's some insight there.
Yeah.
I would not posit that you should build an algorithm purely off that, but one could argue there's some insight you can take from it.
You were about to say something.
Yeah, I was going to say, so the difference between, kind of the financial statements and everything that happens in between is everything that happens in between. So it is wonderful, once in a while to hear from management, and it's formal and everything, but you do want to be tracking the progression or the trends that are happening within the company. And one thing that alternative data, I think, really kind of changed for the overall industry is the agency problem. So we went from, the world where the management was incentivized to deliver a specific message, right? And they would deliver the same message as they were supposed to, and everything was nice and smooth, and once in a while there would be a really big blow up. Now every single move by the management is actually observable in real time. And this is, for people who are tracking the companies, for investors specifically, it's a very, very important way to confirm, is this company doing what the management promised? So, if I'll give you a good example. We were looking at Tesla back in June, and something like just popped up on my screen saying Tesla just cut 1,000 jobs, literally job postings, and this was day over day. And very immediately, kind of interested, like what actually happened there. And we have this blog, which not for investors whatsoever, just kind of for fun. So we wrote a blog post saying like, oh, Tesla is like massively cutting their hiring plans. Of course, a lot of investors came after us. Even though it's not investment advice, a lot of people who are like pro-Tesla came after us. And then only 6 days later, this was June 6th, only 6 days later, they actually announced their restructuring plans. So the management was doing it, it's just we managed to capture it like so much earlier. And it's true of almost any sort of source of alternative data. It's the in-between that counts. And as an investor, I mean, you want to be making money, along the way. You don't want to wait till the announcement because then it's priced in. Right. So that's kind of our perspective. It's happening, and you have to be watching what's actually happening, not just what they say.
So what do you think is the biggest challenge with alternative data? Is it capturing the data? Is it structuring the data? Is it finding not only the structuring, but the right context for the data?
Contextualizing. I think that's the best way to describe it.
So shouldn't artificial intelligence do that for us?
But artificial intelligence, define artificial intelligence.
Everything
it can
but me.
recognize pictures, it can... I think what we're seeing is a lot of machine learning. And those machine learning algorithms, they're much faster, they're much more efficient, but they're not really different from what we've seen 10 years ago. When I started kind of my first like quant fund, and we were like, okay, we can have self-executing algorithms. I don't think algorithms themselves evolved that much. It's the execution part that got much better and much faster. But I don't think there is anything that makes decisions. It doesn't make decisions outside of the parameters within which it's set.
Absolutely. It's in a way, it's a black box. We just tell the black box to be a little bit more transparent.
And faster.
And faster. And faster. Faster. Interesting. Thoughts? Sandeep?
I do agree, like contextualizing the data is probably the most important aspect of data science. It's really like the way you bring alternate data into like the full investment process, where you can look at it, as I said, when you're trying to look for stocks where there's a certain story, so just turnaround, right? And then you're trying to see, okay, these turnaround stocks, how do they, and then combine that with names that are going to be the quarter for restaurant names. I think that combination is where you can basically derive the most bang for the buck, essentially.
No, it's fascinating because it's almost like there are three things that are driving the process: is cheaper computing power, cheaper storage, and continuously improved algorithms and continuously improving computer software. I'm absolutely fascinated that you can go and you can download Python packages, R packages, and with very, very little knowledge, you can create extremely sophisticated approaches to analyze large-scale data. These didn't exist 15, 20 years ago. It's really revolutionary in so many different ways. And that goes also about what other technologies can there be out there that can disrupt the investment process. What are your thoughts about that?
If I can say something. So my cat can play a game on an iPad. 10 years ago, no cat was playing on an iPad.
Because
that's how user-friendly technology got, which is, for all of us here, it's a great thing, right? Because you suddenly don't have to be a quant, you don't have to be a data scientist. The tools are being built for you specifically to be relatively user-friendly and relatively easy to interpret. That being said, there is still there are a lot of things that are being built right now that will probably completely change the process, but I guess the good and the bad thing is we have no choice. The movement is coming, and we cannot be, if you want to be out of it, you cannot be an investor anymore.
Yeah. Right, so there is the speed of technological transformation, and the question is, how can analysts capture that?
Right. Yeah. I mean, I personally think like there is, there's a lot of inertia on the buy side. So if they're used to a certain way of analyzing data, so it's Bloomberg and Excel right now, you've got to have, or you've got to provide value in two aspects. One is efficiency. So as an example for efficiency, as I said, you're combining your fundamental philosophy with some of the alternative data instead of actually getting your fundamental philosophy down into a set of stocks, alternative data into a set of stocks, then trying some cobbled together process in Excel. If that's one click, that's efficiency, so that gets adoption on the buy side through the efficiency aspect. The second, I think the more important aspect of, or what's going to lead to more adoption is you've got to be able to provide insight. So say, you're basically just putting in your estimates for restaurants, and you've got all the rich history where you have your estimates, and then you have the consensus. And then if you're able to mine that data and then there's sort of a feedback loop back to the analysts, back to the PMs that, hey, you guys are always overestimating sales across restaurants, right? That can then help feed into the process for portfolio construction. So I think efficiency and insight, those are the two things that need to be there in any software package or any technology for it to be adopted by the buy side.
Stephen, you're thinking, I see that you're thinking.
I'm going to speak from a buy-side perspective since you and I were talking about this earlier, Peter. I think the major disruption that's going to come is going to be in the construction of portfolios. The way portfolios are constructed today are the same way they were constructed 10 years ago, 20 years ago. I think the advances in AI, I tend to be a little bit more positive about where I think it's going to go. It's still in its nascent stage, but it's going to go towards portfolio construction because that's the end game. Right now, if you look, using what you were talking about earlier, Peter, look at all the packages, look at what people are doing. It's really cool algorithmic trading, spread trading. I'm personally not intellectually interested in it. What really caught my attention was, this was about 6-7 years ago when people started talking about how you can use AI to construct portfolios. How do you create the right allocation for Apple in your portfolio? I was trained to look at what its weight was in the S&P 500, and then I would talk to my portfolio manager about whether or not we were 1% or 2%, above or under. Then I learned about mean optimization, Sharpe ratio optimization. This is old stuff. Now you have clustering in the approach of looking at different ways of building portfolios, perhaps using neural networks to build portfolios. I think that's where the major disruption comes. And when it comes, I think at least for the buy side, which I've always found to be very, very behind the game, much more so than the sell side, I think that's going to be very disruptive, both for the size of teams, and the investment teams, what's going to happen there, the technology teams. Sales teams are always going to be what they are because they're selling. But for the investment teams on the buy side, I think it's going to be tremendously disruptive.
And where do you see the biggest disruption come from? And how will that impact the buy side?
I would, if you were to ask me now, my background's in portfolio management, and on the research side, I would tell you teams have already shrunk from 10 to 15 analysts. I was part of a team that was 10 to 15 analysts looking at global stocks. Will be 4 or 5, maybe with one portfolio manager, covering 2 or 3 different strategies. Whereas before I was reporting to 5 or 6 different portfolio managers.
So this kind of moves us in a slightly different direction, but I'm just curious. So are we talking about smart alpha or are we talking about smart beta?
I want to answer that.
You want to go? You go.
I think it's smart alpha. So what happens is even if you see where this industry is headed, you're not going to be able to replace traditional fundamental analysts. They just know too much about a company, so they're really good at, say, they can come in and say, look, Chipotle, I think it's going to beat by 3%. That you can get from, say, the credit card data. But then how that translates down through the income statement to actual EPS, they're very good at understanding that because they know management, they understand the sector really well. But they're probably not as good at portfolio construction. So they're like, okay, this is going to beat, this should be a 3% position. Based on what? So, those are the things where technology can really help with that. And then even in terms of assigning a price target to a particular stock, you can say, okay, this is Chipotle is going to earn $20, but then I'm going to assign a 25 times multiple. why are you assigning a 25 times multiple? What is that steeped in? Where is the backing for that? So for that, I think you'll have a lot of tools which will help you break down your price target and then ultimately help you construct your portfolio in a more efficient manner. So I think that's where the industry will probably go.
So it's capturing the information in a completely different way.
Right. I mean, yeah. So traditionally, people have just been like gut feel about this, and I just think with the tools and technology out there, the traditional analysts are not going to go anywhere. They're still going to be like figuring out what the actual numbers are going to be, but then everything else as part of the investment process, and what Stephen alluded to was portfolio construction, and even in terms of assigning deep valuation analysis, all of that can be quantified.
Okay. So how do you see the new technologies, these new technologies that are emerging, getting embedded into the workflows, both on the buy side and to some extent in the sales side?
Do you guys
want to?
Yeah. I think it's going to be a slow process. As I said, you've got to basically people have to look at the merits of the platform along two aspects. One is obviously the efficiency, and the second is additional insight. So if you're able to prove that this is going to rapidly decrease the amount of time I spend in filtering down the ideas or help in portfolio construction, that's definitely going to get adoption. And then the second thing is the feedback loop that you can get from putting all your data onto a system, such as, hey, I'm always bullish, or I always overshoot my estimates in the restaurant sector, and that can help you when you try and put in your numbers in the future. Now you could say that machine learning could take that over and say we'll correct automatically for the biases, but from whatever we've learned, speaking with all our buy-side clients, is they don't want us to take over that process. They want us to give them the insights, and that insight will help them improve their process, which is still sort of like more touch and feel, but then you put that into a system to help automate some of it. Does that make sense?
I think I actually have something to add to Sandeep's point. So yes, to some extent, a lot of the buy side, they still do want insight, but I think your previous question was the difference between the alpha and the beta that's going to come out of it. So the way I see it is actually going to be a much broader gap. So the really, really alpha generating strategies are going to really separate from the rest. And part of the reason is going to be because there will be and there are already firms that actually do want to find their insight on their own, and they don't want to share it. So they don't want to get a signal from you. They actually want to get something that's workable and something that's contains valuable information, but they want to come up with a very complex, structured way. Because anything in the markets, it's not like a linear, simple regression type of relationship. There are a lot of moving parts, and I think the smartest players, the ones who are going to win in this, actually, they do want to get, not raw data, that they want to get something that they can merge with their own databases and their own ideas and really kind of create very unique strategies, which ultimately is going to probably change the business structure of any buy-side firm and probably in sell-side firm. I always think about, example of like developers. 5-10 years ago, you could have like a really genius developer, and he could sit at home and just build an app, and this app is going to sell for millions of dollars, and he's set, right? When tools like GitHub, Slack, I don't know if you guys use them very much, but when those tools were invented, it actually changed the whole like process of development. So now the best technology is actually built by teams, and those teams tend to have, front-end engineer, back-end engineer, data scientist. And I think finance is, in a way, actually moving in the same direction, because you can't really have one without the other. So I think they're going to go from a kind of like 1, 2, 3 superstars within a firm to actual very collaborative teams, which are good for everything, because there's no person that can do it all, right? We all have our skills, we all have our strengths, and we have our weaknesses. And I think this, this new environment is actually going to bring around much more collaboration than the previous ones did.
So you think that this is going to lead to a fundamental change in the culture?
I hope so, and in a good way. In a good way, because suddenly, it's still wisdom of the crowds, right? That's all the markets are, but suddenly you need this much more diverse skill set to make a truly unique, valuable strategy. And that's how, that's how people get brought together. Get brought together because they're making money together.
Right. And ultimately, it's not, they're making money for their clients. Because
For the,
that's-
for the clients, for
the clients.
themselves,
Yeah,
for,
for the clients, for the clients. That's the important part. Okay. So let's just go back a little bit about the use of these various methodologies. And Stephen, from your experience, do you see any major differences how these new technologies, new approaches, new methodologies, new data can be used across the different asset classes?
Sure, and also how the different asset classes integrate with each
Right.
other, right, and interact. Can I touch on an earlier point that you were talking about, what's the future of the buy side a little bit? Because I know Katya and Sandeep both expressed their point, and I actually have a different perspective. I think it's going to be completely different. I think it's going to be the QuantaMental investors, the next evolution, it's the next step. I don't think you're going to have fundamental investors anymore, and I think Katya's right. I was writing down as my notes, AI is still dumb, right? And it doesn't really understand real risk. You need a human perspective to understand real risk. And I'm not talking about market risk, I'm talking about geopolitical risk. Way over allocation into things, which happens quite a bit with quantitative strategies. I think the new funds that you'll see emerge in these firms, it's not going to be what you're trying to do, Sandeep, and convince the fundamental investors to adopt QuantaMental investing. It's going to be the new funds. The new funds are going to all be either multi-factor or QuantaMental. And that's going to be the culture change you see. It's going to push forward like that, the new evolution of funds.
But then that sort of begs to the point that it's going to be essentially smart beta, not smart alpha. That
I think the
feel-
move towards smart betas, I think Peter was
Yeah.
trying to push me on that.
Now, I think the evolution is very fast. I mean, it's going to be fundamentally disrupting the market. And then the question becomes, if I am a CFA, should I go out and learn Python, or should I hire a team who teaches me Python, or should I be ditching my CFA and just learn Python?
I think I can answer this one. So remember when you were like learning to ride a bicycle when you were little?
That was a couple of years ago.
Okay, yeah. So you didn't have to learn how to actually make a bicycle. I mean, some people in Bushwick now will actually argue that point, but you didn't have to learn how to make a bicycle. When you were learning how to drive a car, you didn't have to learn how to be a mechanic.
Thank God.
It's actually an interesting story. So when jet engines were invented, there was very quick movement towards like, oh my God, we all have to learn how to fly because we're all going to be pilots. That's how we take advantage of it. We don't actually have to, they're professional pilots. So, it's good to have the knowledge of how to use tools, but do you really have to be a professional coder for this? Absolutely not. It's like everything else, they're specialists.
I think, so my firm belief is obviously that fundamental analysts are not going to go anywhere. So it really depends on where your passion lies, right? So if your passion is understanding companies deeply and doing a lot of fundamental analysis where you really want to dig into that company and just analyze the hell out of it, then you probably want to be a fundamental investor. Not saying that you shouldn't take a one-on-one course on data science to understand everything. So as Katya mentioned, basic understanding of what all these numbers and what stats mean and how they can help you with your investment process, that is critical. But you still have to follow your passion. So if you're a CFA charter holder, but you're more passionate towards building product or data science, then you should follow that and then work with the investment teams, the fundamental analysts, to essentially try and create smart alpha or alpha, essentially. So that's where I think it really depends. You shouldn't change, you shouldn't become like a Python coder just because everyone else is doing it. It really depends on where your passion is once you've completed the CFA or while you're doing the CFA.
I feel like I'm the outlier. How about I couch this in the perspective of what I tell some of the 23, 24-year-olds that work for me. I think that's probably gives my perspective. Full disclosure, I'm the son of 2 PhDs, and I'm a black sheep. I didn't go get mine. I tell them they should study the CFA and learn Python. I think that's where the future is going. Now, is Python the be-all, end-all? Probably not. It's going to be another language. I happen to be fluent in R. It's probably a waste of time for most people to learn it. I think it's a pretty cool language. It's used in economics quite a bit. There are newer languages like Julia and Golang that are coming up that will probably take over Python maybe 5 years, 10 years from now. I think if you're thinking about going to data science, going into quantitative investing, I think it's good to have both the CFA and a background in coding. I'm speaking from my own perspective. I have both. I think it gives you insights that traditional quantitative investing won't.
So we have 50 minutes left. So just very, very quick answer to a very, very difficult question.
Okay.
And this is the crystal balling question. So where are we going to be in 5, 10 years down the line? How will this data science, alternative data, new technologies, new languages, new knowledge transform our industry? What are your views?
So what's alternative today is clearly not going to be alternative in 5 to 10 years. So it's going to be, evolution is normal. It just has to go the same way. It just will keep on discovering new ways and new things. But the tools, the adoption of new tools is going to be, I think, the leading part of this whole movement.
So it's going to be faster, more rapid, more disruptive?
I mean, there is a physical limit to speed, right? So at some point, speed does really make a difference, but I think it's going to be much more transparent, which, for investors, it's a really, really good thing to have transparency, because one thing that CFA Institute always encourages you to follow is fiduciary duty.
Right.
So you have to know everything that's knowable. Well, if everything that's knowable out there and it's technically available to you, aren't you responsible as an investor to take advantage of it? So the transparency, I think, is going to be the major game changer here.
I think in 5, 10 years, the firms that are going to survive are the ones who leverage technology to scale their investment business. So what that means is, traditionally you've had like 15, 20 fundamental analysts, right? And they're covering a few, X number of stocks. When you apply technology, you probably don't need to have a separate person who's saying, hey, I want X% in this particular position, I want Y% in this particular position. So I think it really helps take that mental mosaic. That's how a fundamental investor says, right now I add value because, I know this is a turnaround story and, I think there's a catalyst coming in. But now that that there's a turnaround story, that can be quantified. There's a catalyst coming in, you have data that proves. So I think when you try and scale your investment business, which is you're not just covering Chipotle, but all the other names, that is going to be possible with technology. I don't think fundamental analysts are going anywhere, but fundamental analysts will probably not be as involved in portfolio construction, not be as involved in valuation analysis, but they will definitely be involved in the deep fundamental work that they do on companies, because I think that's like industry experience that's built over like decades, right? And that is something that you can't really replace, or it's not that easy to quantify. That's my personal opinion.
Stephen?
I'm going to talk again a little bit more about how portfolio construction is going to be done. I think Sandeep was hitting on this earlier. It's been glacial, the adoption of technology and AI to finance. We were chatting this earlier. If you look at the consumer industries, it's been like that, rapid. Now, that's obviously because they're beholden to investment professionals, whereas the buy side can afford to be a lot slower, and it's been pretty slow. If you look at what's being implemented now versus other industries. I think if you talk about the next 5, 10 years, portfolios are going to be constructed with pure AI with human overseers. That's really what's going to go. I think people really underestimate, at least on the buy side, what technology and AI can do. And that the way we construct portfolios, the way we make allocations is Byzantine. And that AI and technology can really help you make better sense of things. And part of that has been the advent of big data. With big data, AI has become more powerful. Otherwise, it'd be more or less useless. You'd be looking at the same data.
I've asked way too many questions. And I could go for hours. But I know we have an audience, and the audience is incredibly wanting to ask questions. So who will take the first question?
Thanks. My sense is a lot of portfolio managers may be tempted to look at this realm and want to boil the ocean, be the next Two Sigma, Rentech, et cetera. And I'm wondering, in your experience, how often it might be to their benefit to try to keep it simple and separating the signal from noise, not try to incorporate 24 data sets, but rather maybe look at 1 or 2 alternative data sets and just get things like position size right, et cetera, and just kind of narrow the field and learn where there might be predictive power and alpha rather than try to boil the ocean?
And you're asking the question from?
I mean, anybody could offer answers.
Happy to pitch in. So from my experience, working kind of with quant community as well as very fundamental community, even sell side, individual investors are going to ask for individual types of questions. So you never want to overwhelm them. And that's again, going back to the idea of building something very user-friendly. You want your tool to be so user-friendly that the most fundamental analysts can get the answers they want, and the most quant fan out there can still keep on looking for signals and actually keep on finding them. So it's really case-by-case basis, but you always safer kind of on the side of being super user-friendly as opposed to building something super complex and too black box. Black box in, black box out, that's what hedge funds are trying to do, so you don't want to replicate them in a way.
Yeah, my personal view is also that you have to start off small, which is try and integrate data that can essentially help with efficiency in the process. And then as part of efficiency, obviously, when you're trying to create a system, you have to provide insight. So example, if you're bringing price momentum or alternative data into the process and you're like, okay, these are the alternative data and my fundamental factors and I want to combine them together. But then historically, how has this data set or the signal that I'm getting by combining those two, how has that performed in the past? And then use that to maybe make a prediction for the future. So I think it's both efficiency and additional insight. And if you can try and prove value along both those aspects, that's when you get adoption. It has to be slow.
Steve?
I would probably say you were nailing it. It's all about getting the right position size. I think if you keep it simple, stupid, that's probably the better approach. If you can at least qualitatively explain what your quantitative models are doing, that's probably the most important thing.
Yeah, I mean, it's really because they're fairly complicated statistical models, and we didn't go into the details, but I mean, it's really like watching sausage being made. You don't want to see it, and making that credibility that the model that you're using is credible. That step, that leap of faith, I think it's very, very difficult. And I think that's one of the aspects that many regulators say that they have a concern with some of these artificial intelligence-driven funds.
I would totally agree. I mean, you have neural networks on top of neural networks. We're experimenting that with ETFs. You have one algorithm on top of another algorithm on top of another algorithm that's trying to predict price moves. You could overcomplicate it to the point where you couldn't in any way qualitatively explain what you're doing. Because I'm saying, hey, the performance is great. I think it'll be great going forward.
And then you have an algorithm that coordinates the algorithms.
Sure.
Okay, fair enough. Next question. Yes.
Thanks very much. So as a CFA charter holder, and we spent a lot of time reading about traditional portfolio optimization and Markowitz and Sharp and Fama. This is directed more at Stephen, but welcome any other answers. Like if we wanted to learn how to do the same thing with AI, who should we be reading? Who's going to win the Nobel Prize for that? And what should maybe the 30-second pitch on what the CFA should be adding to the curriculum to teach future people to do that?
I promised him I'd plug his name. Great one to use is Paul Wilmot. Now, Paul Wilmot's tutored me, so I'm going to say that. But Paul Wilmot's considered one of the top leading quants in the world. He also happens to make things simple. It's a great way for a CFA to get into what's going on. In terms of all jokes aside, in terms of portfolio optimization, it's also be great to get involved in some of these online quantitative communities. You were talking about GitHub. You can go to Quantopian where you see people, not just retail investors. You see more serious guys going back and forth about what different forms of portfolio optimization works.
My view on this is it's actually probably going to be crowdsourced. So I don't really believe that, at this stage we can have one or even one person or a team of people really creating something that's going to completely revolutionize the industry. Meanwhile, we have perfect basically environment to really make anything crowdsourced really work. And, by default, it's going to be the most successful idea out there. So I think that's our hope.
Yeah, I mean, if you look at almost everything that's being developed now, it's crowdsourced. Yeah. Yeah.
Can I just say, there's some really good research out already. The Prado, who's now at AQR doing quantitative strategies, he came up with hierarchical risk parity. You can get access to all his back tests, how he compares it to different types of strategies, just on Quantopian alone.
I mean, they invented pandas and a lot of other things that kind of like started the whole movement, and they publish them, which is great. They make it, community property, which is awesome.
Yes, the first speaker, Matt, talked about how what you guys are doing, data analysis, is most relevant for less than 3 months time frame. So if everyone becomes experts in using quantitative data, does that mean that the average fund will have 400% annual turnover, and we're going to have more events like we did this October, where you've got the market swing like this as everyone moves in the same direction?
You're talking about factor overcrowding and everybody kind of running. I think that's the inevitable, right, where everybody goes after the same strategy, whatever it is you're talking about. How about risk parity? And suddenly something happens where every single fund is rebalancing, every major fund. I think you're hitting on that. It's probably going to be a natural evolution. You could argue that value investing was the same way 10, 15 years ago, where everybody did the same thing.
I mean, I'll just tell you, like some of our clients, they use alternative data as one of the pieces in their mental mosaic. So it's not an island itself. Hey, I have to get this quarter right because that's going to make me money, and then after the quarter I'm out. It's really as something to validate your thesis. So I am buying Chipotle because there's a turnaround story and process where the margins are turning over and they're going to go back towards its historical means. And I have the supporting data of credit card, which is helping me sort of validate my thesis and just making me not stupid if suppose I have a 3-year holding period on this, and I just need to know if there is anything out of the ordinary that's happening with the credit card data that could disrupt my thesis. So I think that's where at least the clients that we work with are using some of the alternate data. So I don't think this is going to happen, or at least the smarter funds, they are going to use alternate data as one of the inputs for probably longer term investing strategies as well. We use the alternate data as a validating point.
You also will require thinking more creatively about the same factors. So if you and I took the same data set, raw data set, theoretically we should be looking at it differently to create factors that we're using for our funds. But I think your point about factor overcrowding is a serious problem, at least right now.
Yeah, I kind of agree with both of you guys. I think it should really be defined by the strategy of specific investment vehicle. How often do you actually rebalance? How often do you actually trade? In terms of alternative data, I mean, you can get anything from super high frequency to, relatively like long-term 10+ year patterns. So it should really be defined by investment strategy. It should not be defined by, I see something, I jump on it. It's the same thing as news, right? You see something in the news all the time. Does it make you rebalance much more often, even though your strategy says otherwise? No.
Yeah, thank you. My name is Raphael Douadi. I run the mathematical finance program at Stony Brook University. I wanted to answer the gentleman who had a question about the programs in data science because precisely, so, I mean, there are several...
Let's have that discussion afterwards because that's... Let's have that discussion a little bit.
Okay. Well, because precisely I wanted to make a simple announcement because I'm precisely currently building a partnership with the CFA to address exactly that question. So normally, starting next year, you should be able to. We should be able to propose a program, precisely certificate of financial data science, for CFA members to get this education.
Thank you. Okay. Okay. We have time for exactly one more question.
You guys have a variety of different types of clients. I'm just kind of curious how, for each of them, their willingness to accept some kind of mathematical or AI, artificial intelligence signal that you're giving them. I'm not sure how each of you present this to your clients. Like I know buy-side professionals are not going to just accept some kind of signal that's coming from a quant shop. Quant fund will make their own. That's less transparent, and especially on the retail side. Can you give a couple of maybe concrete examples of how you're providing some of these tools or signals to retail investors that they can understand and actually make a decision that they're confident in?
I mean, this is a little bit tough one. So I do not feel like a lot of the alternative data tools and general tools around quantitative finance are kind of ready for more, retail type of finance. And, one of the dangers, I mean, you probably saw this was kind of crypto space. If it sounds fun enough, like everybody's going to jump in, and then next thing you know is, you have bubbles and you have bursts and you have more bubbles. And I'm really against the idea of bringing this into retail before you bring it into all types of institutional clients. So in my experience, hedge funds, especially quant hedge funds, are of course the first adopters of everything. I think sell side has been doing an amazing job of actually keeping up, which is a big surprise, but I think, it might have been like 2008 that really shook them up, but now they understand that, the relationship is not the one thing that's gonna, make the money. They have to actually sometimes stay ahead of their clients. So I think the overall sense right now is actually both buy side and sell side are moving in the same direction. There is absolutely no reason to bring in retail at this stage into something that can be, potentially confusing. If it's confusing to us on the institutional side, it's definitely going to be very, very confusing to retail.
I think your question was how are we making it easier for institutional investors to digest a lot of the quantitative data, right? So, I mean, we do that in parts of our platform by just saying, look, this is correlation and this is R square and here's the p-value, but we're just going to basically say, look, what this is, so we have a very simple example we give our clients as well. We say, look, you can see Apple stock over the last 10 years. You can see gross margin, sales growth were really important. And now the most important driving factor for Apple is free cash flow margins, free cash flow growth. So that's an example. And they understand that intuitively because they're like, okay, we understand that the investor base for Apple has moved from a more sort of top line gross margin, sales growth perspective to more like a value-based investor. So you can clearly see that in sort of the numbers. So as long as they can identify the numbers that you're giving them with actually what's going on, the story behind the stock, then they're more apt to adopt it or listen to you or adopt your platform.
So QuantaMental is geared only to retail investors. So I really do feel an island here. I'm disagreeing with my colleagues on the panel. I have actually not found the adoption from retail investors to be that difficult. I think it's the same thing as marketing a fund, and that's what I did most of my career. Transparency, the ability for the retail investor to break down through to see the details of what you're doing, making sure it's not a black box, but it's something very transparent in English. We can talk about R squared. Rather than talking about that, discuss the trade, why it's being there from a QuantaMental standpoint. Here's what the quantitative model is doing. More importantly, giving the results of what you've done before. I'm not going to get into our marketing pitch for how QuantaMental is going after the retail market, but my experience, it's limited. It's in the context of QuantaMental, I've spent my career on the institutional side, is that the retail investors are they're much more skeptical of institutional Wall Street than institutional Wall Street really appreciates. Really skeptical and cynical. They just do it because they have to. There's no real other choice at the moment. And two, they're a lot smarter than many of us on the institutional side think. That's my 2 cents on that.
And with that, I would like to thank our panelists for their insights.
Thank you to Peter and the panel. Pratik will introduce Stefan.
Stefan is the founder and lead data scientist